All right, and welcome back, everyone. Money Show is pleased to welcome Thomas Lee. He's the managing partner and the head of research at Fundstrat Global Advisors. He is an accomplished Wall Street strategist with over 25 years of experience in equity research and has been top ranked by Institutional Investor every year since 1998. Prior to co-founding Fundstrat, he served most recently as JP Morgan's chief equity strategist from 2007 to 2014, and previously as managing director of Solomon Smith Barney. His areas of expertise include market strategy, small mid-cap strategy, and telecom services. Thomas, it's an honor to have you here today. Thank you for taking the time. It's all yours.
Hi, welcome everyone. I've got a presentation, and over the next 25 minutes, just going to give you our thoughts about equity markets, what's going to drive markets this year, our take on where your opportunities will be. And of course, a lot of this has to do with, how we navigate this through two really big transitions. One is a new administration in place, and the second is the economy reopening. So at a high level, I want to start with this slide on slide 5, which is, when we look back at 2020, we have to have a perspective on why those markets did what they did in order to really have a way to kind of ground and frame our view on 2021. And as you know, 2020 was a year that hopefully none of us ever experience again, because we had a global pandemic, a global economic depression, the need for central banks to really take unprecedented steps that essentially rewrote the entire rule book around what a central bank is. And despite all that, the stock market, after initially crashing, made a really vigorous bounce. But part of the reason that happened is that that's actually the history of equity markets. And I think 2020, to us, the biggest lesson was to realize that there's an inherent symmetry in market behavior. And what I have here on slide 5, this is a chart we first produced for our clients at FS Insight on March 24th. And it shows that if you look at the 10 declines of markets of more than 35% since 1929, 10 out of 10 times the market's recovery was symmetric. So the faster you fall, the faster you bounce. In fact, if you look at the median for this, it basically says that if you fall at a certain speed, it takes you half the time to recover those losses, and then 2.5 times, however long it took you to fall, to go to new highs. And if that was true in 2020, the market would have recovered to 2,800 by mid-April, which it did, like textbook, and it would make new highs sometime in the third quarter, which it did. So 2020 was a reminder that despite a lot of things happening in equity markets that we've never seen in our lifetime, the way the equity markets actually responded to the bad news and then recovered from the bad news was actually completely textbook. And as we think about 2021, there's a lot to keep in mind, but for the most part, I would say that the outlook for this year is better than last year. And because of these factors, I think equity returns will be even better than they were last year. And so, if we were to run down, number one, we have a new expansion starting. The central banks, and despite the recent nervousness, are dovish. And I think even today's bond market test of the Fed was really essentially something the Fed could easily fix. We have real interest rates negative, and that's another thing. As rates are rising, I just think the impact on the equity markets is so small, especially compared to how big fiscal stimulus is. Credit outlook's positive, and I think that investors are going to shed their fear as the economy starts to reopen. And so for that reason, I actually think one of the big takeaways is that in 2021, we have to keep in mind that the stock market proved to be unkillable. In fact, whatever doesn't kill us makes us stronger. And I think that's going to be even more true for cyclical stocks. So what does that mean for this year? Well, this has been our sort of framework that I think if last year was about symmetry, this year is about reversion of cycles. Profit margins are recovering. We have an investment cycle that's underway. Volatility, I think, is going to revert to much lower levels. And again, I can't be more emphatic about this. I believe there's a growth value reversion that's underway, and that is really important because you need to have a lot more cyclical exposure if that's true. And of course, that stocks are going to start doing better relative to bonds. So that's been our sort of key views. And on page 10, it's a rough, this is something we published in early December, and it's just a rough framework, but this is how I would sort of try to think about how this year would map out. That we'd rally towards 3,900 to 4,000 and peak sometime between February and April before a decline to 3,500. And then the markets would then recover strongly and exit the year well above 4,300. So that's our rough framework. It's a framework, so don't hold us to this. And I don't really want people to think that corrections are something they should worry about. I mean, you'll never make money worrying about a correction. You'll make more money worrying about your upside. And so that's why I'll take us to slide 13, which is, as you think about 2020 so far, 2020, the bull market started in 2020. I think you should be comfortable that because it's the start of a new expansion and we're coming out of a pretty dramatic stock market crash last year, that the future returns aren't really limited to what happens in 2021. I think that we are really entering a period where stocks could do well for a multi-year period. And so again, as an equity investor, you should really be thinking of any correction as an opportunity, not something you need to be selling and trying to get out of the way of. Here is our view on sectors. So the natural question is, okay, well, Tom, if you're bullish on stocks, how would you want to be positioned? And again, this is our sector recommendations that we established in December, but they're still very true today. We wouldn't change anything yet. Which is, we took the market, we really broke it up into growth defensives, which is 2/3 of the S&P, and then cyclicals, which we call epicenter, which is 1/3. And out of the growth and defensive sectors, we only have an overweight recommendation on tech and communication services, and underweights in real estate, staples, healthcare, utilities. But we're recommending every epicenter sector: discretionary, industrials, energy, financials. And then in these blue circles are my top 3 sectors. So the top 3 sectors that we wanted to start the year owning is consumer discretionary, equal weight, industrials, and energy. And as you can imagine, you might wonder, well, why do we like these 3 sectors? Well, discretionaries, and I would include media in this, it's going to have a lot of leverage to a reopening. But these are also very good companies at adjusting to new conditions. So as we went through a really restricted economy, these companies cut costs dramatically. And now we're going to be able to see their ability to generate operating leverage. So that's why we're overweight discretionary. Same thing with industrials. Industrials are your best way to play fiscal stimulus, because especially because it does look like it's include a substantial piece of infrastructure. Well, that's why you want to be overweight industrials. And the third sector that we like, but it's probably the least consensus, is energy. So we think energy is a must-own group. And the reason we've felt this way is that it's the one sector that's going to have the best alignment of supply and demand in 2021. Now, part of that supply demand alignment is that supply is going to get more restricted because of the White House and their somewhat negative policies towards traditional fossil fuels. There's capital scarcity because we know that public markets and private equity aren't going to bail out the industry like they did in 2016. But the demand side looks pretty favorable because as the economy recovers, people are going to get back on planes, and all of this is positive for oil prices. So, again, I might just say the one sector that you need to get right this year is energy. because if you get energy right, it might cover up for a lot of problems in other groups. And if you want to know, is there any price reason to favor these groups? Well, look at discretionary, and you can see here they really are bouncing along a really critical trend line that has been in place for 40 years. So I think it's a group that is going to work this year. And if you look at industrials over the last 90 years, this is an important support level, and it looks like industrials have bounced off that level, which is good. And the reason I think energy is so interesting is the prospects for that sector are so bleak that the relative price performance to the equity markets is the worst in more than 90 years. You have to go back to Moby Dick era to find a time when energy stocks were worse. So, to whale oil days, which is the reason why we like energy, because, it's grossly mispriced. And if you're a client of FS Insight, then you're going to be aware that we've done a lot of analysis on the price of oil relative to both XLE and OAH. And we show that even at $60 oil, OIH and XLE have, well, OIH probably has 200% upside and XLE has over 50%. So oil doesn't even have to rise from here. Energy stocks just need to catch up to the move in oil. So now, something else that we've thought was important to keep in mind is that if people are going to start believing that there is a return to a normal economy, that rotation would be violent. It's a violent of action. And the reason we felt it was going to be so violent was that most people spent 2020 protecting themselves by buying growth stocks. And growth stocks did really well last year. But if the economy is going to open, it's going to be less appealing to be long growth because other things will have a lot of growth. In fact, something that we've been telling our clients is that, COVID was essentially a global war, a war against a virus. And we had to shut the economy down to fight this war. Well, we're now entering a post-war period with reconstruction. And it's being led by a lot of government stimulus. Well, in almost every post-war period, whether it's after World War II, World War I, Gulf War I, II, if you look at the countries that were at the center of those wars, the cyclical stocks became the growth stocks because of all the amount of effort and money spent on reconstruction. So that's how you have to think about 2021. It's a post-war period. And part of that post-war period is also that volatility is expected to fall. So this is the VIX spot, the delivered VIX or the spot VIX since 1990. And we put blue lines to show the average level of the VIX annually. So you get an idea like where it averaged every calendar year. And in 2020, the VIX averaged 29.5. That's the third highest reading for the VIX in its history. And in fact, the only 2 years where it averaged at a higher level was 2009, 2010. But what's interesting is that I kind of like marked it here. Every time you come out of a period of high volatility, the VIX collapses in the following 2-year period. We're talking about extreme high volatility. And so we think that that's the new regime to expect, is that the VIX is spent a year at an extremely elevated level, almost 30, which is insane. And we think it's going to actually make its way towards 10 within a few years. Well, why does that matter? Well, take a look here at the VIX futures curve, which is actually quite liquid. And this is the different months out through the 9 months and the average level for each period. So in 2020, you can see the VIX averaged an inverted year. So it spent many months where the next couple of months ahead were at higher levels in the future. And that meant that in 2020, investors spent the entire year worrying about an impending correction. And in 2000, and this gray line is actually the average since 2005. So you can see the VIX normally has an upward sloping curve, but at today's level, the VIX is just still expecting extreme volatility throughout most of 2021. And I think that's why you have an opportunity, because I don't know if it's warranted that we should be expecting such high levels of volatility this year. And in fact, here's a little scatter to think about that. So on slide 24, I have two axes. On the x-axis, I have the spread of the VIX futures curve, and actually the 12-month average spread. So it's really smoothing it out, saying, what you average for a 12-month period, the spread between the 4-month and the 1-month contract. And the y-axis is what did the S&P do in the following 12-month period. Well, in 2020, at the end of 2020, the VIX averaged -1 for that 12-month period. So it was inverted the whole year. So it falls within this red box because that's the lowest decile. And then the y-axis is what did stocks do in the following 12-month period. There's not a single instance where the VIX was inverted for a 12-month period and stocks weren't higher 12 months later. In fact, the average gains 23%. So you can see the single best time to ever be long equities is when you come out of a period when the market is anxious about volatility, which is why the VIX is inverted. Well, that's where we are today. So to me, the risk reward for stocks is still really good this year. It's very bumpy, and I think it's adding to confusion because a lot of growth stocks are really under pressure. But I think that this is all a setup for stocks to do better. And but here's something else to keep in mind. When your VIX emerges from a period where it's been inverted, which is similar to today, the best expected return comes from cyclical stocks. So historically, under this scenario, if you just use VIX purely as a signal, cyclical stocks should beat growth 84% of the time. And already, again, what are we seeing year to date? Cyclical stocks trouncing growth. The stock market is being pretty rational. I think a lot of this is last year, the market was anxious. They bought growth stocks. Now that there's less anxiety or it should be falling, they're going to buy cyclical stocks. And I'm going to skip a few slides here because you might have a question in your minds that, well, why should cyclical stocks do better? And that's on slide 34. This is showing you the profit margin. It's indexed, so it's not the actual level of the profit margin since 2000 or since 1999. And this dark blue is cyclicals or epicenter profit margin, and the light blue is technology. So you can see that cyclical margins are indeed cyclical. They go down during a recession. But last year they collapsed to the same level they did at the bottom of the market in 2008. So we've had a huge profit reset. That's important to keep in mind because number one, when you've got margins at a trough, you don't expect PEs to be at a trough. That's actually not how cyclical stocks trade. When cyclical stocks are at the bottom, their multiples are high. And so, as you know, people are saying they won't touch cyclicals today because their PEs are high. That's actually what happens. At the bottom, they're always expensive. But look at how quickly they recover. In 2002, they had a massive rebound in profit margins. And look at 2008, a massive rebound. So this is why you're going to get earnings surprise out of cyclicals. And in fact, because of the nature of this depression, the recovery in profit margins might even be greater. So I think there's a lot of earnings surprise. And then, here's something to keep in mind. What are some themes we're going to have in place now that we're emerging from this pandemic? Well, here's the 4 that we think are important to keep in the back of your mind. One is the supply chain's going to move back to the US. You're already seeing problems with semiconductors. So I think supply chain is being triple emphasized this year. You're going to see, we believe, deurbanization, more people moving to the suburbs, and that's boosting demand for housing and infrastructure. I think that people want to still work from home. There may not be additional people, but it's a structural shift. And that means people buy things to furnish their homes, offices. And of course, I think people want to buy more USA product. And so these are all themes that to us favor an increase in spend towards cyclical parts of the economy, which I highlight here. And let's see, I'm going to just jump to a few more slides and then open up to questions. But, one of the questions you might have is, um, you know, is there something else underway that could be bullish for stocks? And yes, in fact, I want to get to that point here, which is I think that you have to keep in mind that one of the bigger sort of stories underway is the story about millennials. And foremost, um, they're the single biggest driver of GDP growth right now because they're at the age where they're having the largest impact, but also they're the largest cohort. So they are the engine for the economy. And it makes sense to think about the market through the lens of a generation because, for instance, in the 80s, the most important generation back then were the baby boomers because they were in their 20s. And baby boomers had a couple of themes, but really what was happening was the creation of big box retail, and also a really big increase in workforce participation. But if you bought the retail stocks that were part of that baby boomer generation, if you put $1,000 into the top 7 names, you had turned that into almost $1.2 million, which was a massive, total return, but it easily beat the S&P. And similarly, if you looked at Generation X in the late 90s, which was when they were in their 20s, and you were betting on internet, the top internet stocks delivered a similar return to the top retail names. And in fact, again, easily outperformed the market. So the point is, today, what the millennials are interested in are probably going to be the more important stocks. And a lot of it is digital, which is why you want to still overweight tech, but not all of it. And here's how you can think about how they're influencing the economy. This is the number of people aged 30 to 50, 5-year growth rates. And you can see that because of different generations and the size of each generation, they've had a different impact on growth. And you can see millennials are such a large generation, they're actually causing an increase in people aged 30 to 50. So again, it's quite bullish. And I think it's going to be a tailwind for equities. And why do I think that? Well, take a look at this chart. This lower chart is the number of people aged 30 to 50, and you can see it's been rising or falling, but because of millennials, it's turning up again. And then this is 10-year rolling return of the S&P. You can see the S&P returns pretty closely track the size of a generation and their changes. And if that's indeed correct, this implies the S&P returns could be accelerating over the next decade, which is our base case expectation. So again, as bumpy as it's been the last couple of weeks, I just think in the world of fractals, it doesn't mean anything. And I think that's going to be it. I'm going to stop sharing there and see if there's any questions.
All right, Thomas, thank you so much for your insights. We do have about 7 minutes or so for some questions here. We had a few attendees write in some questions. Let's see. Question, you said the Fed can easily fix rising rates. If they're the only ones buying their own debt, won't long 10 to 30-year bond rates continue to rise?
Well, I think what you have to keep in mind, the Fed can actually fix this communication error one of several ways. In fact, I was talking to some credit investors today because of this exact issue. And I think that here's 3 things the Fed could do that would cause the bond market to essentially get in line with the Fed, right? Because we know the issue today was it felt like the Fed was hinting at data dependency because they were saying, depending on the state of the economy, they would then think about their current plans. So it kind of gave an out for the bond market to test the Fed. So 3 things the Fed could do. One is they can go back to calendar guidance, which they haven't, but they could just say, look, we're not going to raise rates for 5 years. You want to fight us? We're not going to. And that would immediately change the entire rate curve. But the problem with that is the stock market would go ballistic upwards. because you could, we would all be borrowing money for 5 years at a fixed rate and then put it into the equity market. The second is they can intervene in the bond market through something like Operation Twist. So they could say they're not comfortable with the long end rising. So I wouldn't make any assumption that rates can just go up on the long end. And then third, of course, they can take other monetary measures. So is the Fed out of tools? No way. And look, let's face it, you shouldn't really, if for somebody who's got money in the equity market, the rise in interest rates is pretty meaningless in the sense that it's not really changing you owning equities, making it less attractive. In fact, rates are really low. I think you should just think about how much money is coming from the stimulus from Washington, and that's going to be a bigger deal, and that's coming. So, I wouldn't be getting too negative.
All right, thank you so much. Another attendee writes in, they're wondering if with the yield curve steepening very fast, could 2021 be similar to 2000 or 2008?
Maybe. I mean, look, the future's uncertain. I say that, and I'm not trying to be glib, but nobody knows the future. Is this a stock market bubble? Look, everyone who's trying to sound intelligent says this is a market bubble, but what makes this a bubble? I mean, number one, if you thought it's because prices of the market went up, that's not the reason that you actually have a bubble. Bubbles form because of excess allocation of capital, and so expected returns drop. In 2011, everybody said the bond market wasn't a bubble because rates couldn't go any lower. And guess what? If you sold the bond market and went short in 2011, you missed the biggest bond market rally in your entire life. In fact, bond managers like Bill Gross and Jeffrey Gundlach became billionaires after 2011 because they got the call right. So you don't really want to try to call anything a bubble unless you actually have a crystal ball and we're in a bubble.
All right, excellent. Thank you so much. Another attendee here, they write in, what do you think about XOP versus XLE, less reliant upon Exxon and Chevron?
You know what? We kind of recommend investors have this exposure to the services piece, which is OIH. I guess XOP is similar, but I like XLE because you have to remember when a fund manager has to get involved with energy, they're not going to ignore the integrated. So you want to actually, if you're playing Wayne Gretzky in the stock market, you do want to buy stuff that you think other people will buy. They're going to buy the energy sector, so they will buy the integrated. So XLE is a good proxy.
All right, excellent. Another attendee, they ask, in your opinion, why is the NASDAQ down by a higher percentage than the S&P on the days that both are down?
Well, think of the NASDAQ as a growth index. And we've, at my firm, again, you can find us at fsinsight.com if you're an RIA or an individual. Growth is.
All right, and thanks to all of those in attendance. Sorry, there was a little drop in audio, looked like a bandwidth issue for those last couple of questions. So thank you so much for attending, and thank you to our sponsors and media partners. Without them, we wouldn't be able to hold these events, and without you attendees, we wouldn't be able to have these events as well. So a big thank you. If you do have any friends, family members out there, anyone who's even interested in starting out in the investing world, no matter what the age, have them check out our platforms. We will be streaming live again March 16th to 18th for the Money Show March Virtual Expo. You can check us out at virtualexpo.moneyshow.com. So again, thank you so much for being here. Stay well out there, and we will talk to you very soon. Be sure to check us out again March 16th to 18th.